You know that moment? You're sitting there in the evening. You open your banking app, and somehow there's money in there that you don't actually need right now. Not for food. Not for bills. Not for that debt you've been trying not to think about. Just $100. Sitting there, waiting. And you think, okay, I'm finally going to start investing. This is it. You open YouTube, type in how to invest $100, and chaos. One person says crypto, another says stocks. A third person is selling a $99 course promising to teach you how to trade like a bank. 20 minutes later, you close the tab and go watch a TV show instead. Sound familiar? And I know exactly how that feels because I've been there myself. I spent my first money not on investing, but on confusion. Then a little more. Then a little more. And only a couple of years later did I realize that the problem wasn't that I was picking the wrong stocks. The problem was that I completely misunderstood what the first $100 in investing are actually for. So today, we're having an honest conversation. No promises, no courses, no turn $100 into $10,000 in a month. Just what is actually worth doing and why. If that sounds like what you need right now, subscribe. Here, I talk about money the way a friend would, not the way a broker would. So, let's get into it. Here's the real idea that most financial videos never say out loud. Your first $100 are not about picking the right stock. They're about building a system. Sounds boring? Good. Boring is what works. Before we get to the system, let's talk about something even more important. What's happening inside your head? Because honestly, most people don't lose because they pick bad investments. They lose because of their behavior. There's a study from Dalbar that measures how real investors perform compared to the market every year. And here's the shocking part. Over the last 30 years, the market has returned roughly 10% per year on average. The average investor earned only around 3 to 4%. Not because they picked bad funds, but because they bought when everyone was excited and sold when everyone was panicking. Your brain isn't broken. It's simply designed for survival, not long-term wealth building. Fear of loss is biology, but biology can be outsmarted with a system. The illusion of control is another trap. When you buy an individual stock, it feels like you're managing your money. You're choosing, analyzing, feeling smart. But in reality, you're playing the lottery while convincing yourself it's chess. Investor behavior and gambler behavior are two very different things. One builds a system and waits. The other chases excitement. Now let's talk about structure. I call it the 3 buckets. Before you throw your $100 anywhere, ask yourself, which bucket is empty? The first bucket is security. This is your financial safety net. According to data from the Federal Reserve, around 40% of people wouldn't be able to cover an unexpected $400 expense without borrowing money or selling something. If you're one of those 40%, your first goal is not investing. Your first goal is building a small emergency fund. At least $500 to $1,000 sitting in a separate account that you don't touch. Without that buffer, the first unexpected expense will force you to sell investments, often at the worst possible moment. The second bucket is high-interest debt. Imagine trying to fill a bucket with water while there's a hole in the bottom. If you have a credit card charging 20% interest or more, and you're investing in a fund that earns 8 to 10%, you're simply pouring water into a leaking bucket. Paying off that debt is the best investment you'll ever make because it's a guaranteed return. The third bucket is actual investing. And this is where your $100 belong only after the first 2 buckets are either filled or you're consciously balancing between them. Okay, let's assume the third bucket is yours. What next? This is where the math becomes exciting. Look at 2 scenarios. You invest $100 once and never touch it again. After 30 years, at average market returns, you'll have roughly $760. Not life-changing, right? Now consider another scenario. You automatically invest $25 every week. Same 30 years. Now you're looking at around $120,000. $120,000. The difference isn't the size of the first investment. The difference is the habit and the time. The habit is the real investment. So here's the step-by-step plan. First, open a brokerage account. Nothing complicated. There are plenty of platforms with no minimum balance requirements and no trading commissions. Research the options available in your region and check the details. Second, choose a broad market index fund, not an individual stock, not crypto, not the hottest sector. Just a fund that tracks something like the 500 largest U.S. companies or the global stock market. More than 80% of actively managed funds underperform a simple index fund over periods of 10 years or longer. That's not my opinion. That's data. Third, invest your $100. Just make the first contribution. Don't wait for the perfect moment. It doesn't exist. Fourth, set up automatic contributions. $25 a week, $100 a month. Whatever amount is realistic for you. Automation removes the need for willpower. The system does the work. Now let's talk about the silent killers nobody mentions at the beginning. Fees. The difference between a fund charging 1% and a fund charging 0.1% sounds tiny. But over 30 years and $120,000, that difference can cost you tens of thousands of dollars. Pay attention to a number called the expense ratio. The lower it is, the better. And one more thing, this is important. Don't check your account every day. Seriously. Every time you see a 3% drop in a single day, your brain screams, sell. That's exactly the gap between what the market delivers and what the average investor actually receives. Set it up. Automate it. Then go live your life. Boring? Yes. Effective? Absolutely. Here's your challenge for the next 24 hours. Pick one of these three options. If you don't have an account, find a platform and sign up tonight. If you have an account but no automatic contributions, set them up right now. If you're already doing both, check your expense ratio and make sure it's below 0.2%. That's it. Nothing else needs to be done today. Write "I'm starting" in the comments, just so I know you're actually doing it. You know what I love most about all of this? $100 is not an amount that instantly changes your financial situation. But by building this system, you become the kind of person who builds systems. And that's a different person entirely. One day, you'll wake up and realize that you think about money differently. Not with anxiety, with clarity. Money changes, but you change even more. Now go do it.